Hello, my name's Terry Morris and I'm going to talk to you today about the business cycle, how money circulates around a business. And let's assume that we are going to go into business together. I will provide the capital and you will be the manager of the business. So here we are, there's you on the left and me with the bag of money. I'm going to invest £1,000 into this business. So the first thing I do is to give you the £1,000 and you take the money and go off and prepare to run the business. Now in the example we're showing, you've actually also gone to the bank to get another £500. So you've got £1,500 to start your business. And having got the money into the business, your first task is to set up the business and get it working. So you spend some of that money to buy some assets, maybe an office block or an office suite you're going to rent, maybe some furniture, maybe some equipment, maybe some staff. But whatever it is, it's going to cost you money, and you get the business up and running, do some marketing, and eventually come to a stage where you can sell some goods or services to the public that you have produced. And once you sell them, perhaps not immediately, but soon afterwards, hopefully, you will get some sales revenue, some money in return for selling. And if you're really unlucky, that will be the time when the bank says, can we have some interest please out of your sales revenue for the money that we've lent you? And then we can work out what your profits are after paying interest. But it's not only the banks that will be looking for money. If you make any profits, the government will look for you to pay some tax. And indeed, if you've made profits, the shareholders will say, well, how about some of the profits for us in terms of dividends? So your profits will be subject to paying interest, paying tax, paying dividends, and what's left will become the retained profits, let's say £200, and that money will then go back into the business and be converted into more assets for more sales revenue. So we can see the basic business cycle in front of us, and the two main accounting statements take regard or consider each half of this business cycle. The first one is the balance sheet. The balance sheet considers what money has been put into this business and where the money is now, and we'll have a little look at that in more detail in a little while. The other main statement is the trading account, or sometimes called the profit and loss account, or the income and expenditure account, and this talks about the activity of the business, what it's produced and sold, what interest it's paid, what tax, what dividends, and what profits have been retained. So we'll have a look at these two in a little more detail. First of all, the balance sheet. The business is a separate entity to the people that work in it. So we wouldn't expect the money in the business to get mixed up with their personal money. If we put money into the business, we ought to be able to find out where it is. It ought to be represented with assets. So we will first of all make a list of what assets we've got, and some of those will be fixed assets. Maybe we bought some property, maybe we've got some plant and equipment. We'll also look at current assets, things that we're buying and selling, and the first of those is stock that we may have bought, and this could be raw material stock, it could be work in progress, or it might be finished stocks, finished materials ready for sale. Another asset are debtors. If we've actually sold some goods or services and the people haven't paid us for them yet, then we're expecting payment and we show those as debtors. The money that they owe us is part of the business asset. And then we can look at cash. Cash in hand or cash in the bank, which is readily usable, is included in the cash statement. Now, we may have ordered from our suppliers some goods or services and received them but not yet paid for them. In the same way that the debtors have to pay us, then maybe we owe money to our creditors. So we need to subtract the amount that we owe our creditors from our apparent assets to get our actual assets, our total assets. And they ought to add up to £1,700 because that's the money that's gone into the system. And now we can look at the other side of the balance sheet, our long-term liabilities and our source of these funds. So the main shareholder, me, I put in £1,000. So the business owes me £1,000 at the end of the day. You've taken a long-term loan from the bank, which isn't payable immediately. So that's a long-term loan, a long-term liability of £500. And the £200 retained profit, well, who does that belong to? Well, that belongs to the shareholders. So again, they are a long-term liability. And they together, those three items together, will add up to £1,700, which ought to balance the assets that are in the business. If they don't, then the money's gone somewhere that we need to find out. Now, there's a difference between current liabilities, trade creditors, shown in the first half of the balance sheet. They are bills that are actually we need to pay in the near future. The longer term liabilities, well, we have to pay the bank loan sometime, but that may be 2 or 3 years away. And we don't actually expect to pay the shareholders their money back. It is only a liability if the business ceases to operate. Then the shareholders will look to have their money returned. But whilst the business continues to operate, then the shareholders would not normally expect to be paid their money back. That is a share in the company that they continue to hold.